Hello, I want to welcome you to this training of today. We are going to be looking at arbitrage trading, and we're going to be focusing on understanding arbitrage trading and the principle behind the definitions, the mechanism, the type, and the principle behind arbitrage trading, and how we can take advantage of arbitrage trading and go into the business. What is arbitrage trading? Arbitrage trading is the simultaneous buying and selling of an asset in different market to profit from the price discrepancies. At its core, it is the financial equivalent of finding a bargain in one store and selling it in another price somewhere. This strategy exploits the temporary inefficiencies in the market where identical or similar assets trade at different prices. What are the key takeaways that we must understand about arbitrage trading? Number one, we must know that arbitrage trading is about buying asset in one exchange and selling it in another exchange where the price is higher and selling it at where the price is lower and selling it at where the price is higher. Number two, there are different types of arbitrage trading: pure arbitrage trading, statistical arbitrage trading, subtractive arbitrage trading, major arbitrage trading, and so many others. So we are going to be looking at the various types as we go on in the teaching. What are the opportunities that are the profit opportunity, arising from the short price discrepancies from the same asset across different market? There is profit opportunities. Arbitrage trading is a business of volume, and we must know that. And what are also the advantages? There are so many advantages that accrue to arbitrage trading. Arbitrage trading includes the potential for a near risk-free profit, enhancing the market efficiency and improving liquidity and diversified income sources. Risk and challenges include the risk include transaction costs, liquidity, limited liquidity, modern inaccuracy, and potential legal and regulatory issue. How does arbitrage trading work? Arbitrage trading, number one, you must for you to go into arbitrage trading, you must be able to identify the price gap between one market and another market. For example, you discover that if you are been able to find out that the price of Bitcoin is traded in one exchange for example, $30,000, and you also, for example, in Binance, and you go to Coinbase and you discover that same Bitcoin is being sold for $30,100. So there is a difference of $100, and that difference is where the profit comes from. Simultaneous execution. This same price, just as the same way you are buying, in the same place you are selling, there's this simultaneous execution of both the buying and the selling, capturing of profit. In doing arbitrage, you must be able to capture profit while buying and selling of a crypto asset. Market execution. Repeating arbitrage activity increases buying pressure on the cheaper exchange, and selling pressure on the pricers one. Price convergence. As a result of price across the exchange line, removing the arbitrage will eventually show up. When the price of both the selling and the buying begin to align, the arbitrage will be removed. What are the types of arbitrage? We talk about where said the pure arbitrage. This is where the buying and selling of cryptocurrency simultaneously at different exchange to profit from the price difference. For instance, buying Ethereum at 1,800 on a Kraken and selling it on Binance for 1,820, you have a difference of $20. You know, we have this Spiders arbitrage. This arbitrage exploited the price gap between a crypto exchange in different locations. For a famous example was the Kimchi Premium, where the Bitcoin traded significantly higher on the South Korea exchange compared to that of the US platform, where on the US platform, such as 19,000 naira, $90,000 on the US exchange versus the $220,000 on the South Korea exchange. The major arbitrage. This is not very common in crypto, but it applies a principle whereby the blockchain protocol announces a major or fork or a token swap. Traders may buy the token of that targeted protocol below the expected swap or acquisition value, anticipating a competition in the deal. Number 4 is the convertible arbitrage. You know, in a decentralized finance, this can involve exploiting price difference between a wrap token and its underlying asset, for example, BTC, or between the token and its staking and derivative verse, for example, like ST Ethereum and versus Ethereum, using a long and a short position. Number 5 is the statistical arbitrage. This strategy uses a quantitative model and algorithm to detect the short-term mispricing between a correlated crypto pairs, or a basket of tokens. It often involves a large volume and rapid execution via the trade robot. Number 6 is a triangular arbitrage. Triangular arbitrage is a situation where exploring the inefficiency between Ethereum trading pairs on the same exchange, for example, Ethereum BTC and USD, to profit from its mismatch exchange rate in a rapid sequence trade. What are the pros and the cons of arbitrage trading? Number 1 is risk mitigation. Consider the low risk, as it exploits existing price difference rather than predicting the market movement. Number 2 is market inefficiency. It helps to align price across market, benefiting all participants. Number 3 is liquidity improvement. Increases the market liquidity by adding trading volume. And number 4 is diversification, providing income streams uncorrelated with the market direction. And number 5 is automated potential, a well suited for algorithmic trading due to a clear rules. What are the disadvantages? High competition, dominated by the institutional trader with sophisticated technology. Number 2 is capital intensity, requiring a significant capital on profit, as profit margin are typically small. Number 3 is transaction costs. Fees can erode the profit margin. Number 5 is execution risk. Opportunity disappears quickly, requiring a light, fast execution. And number 5 is regulatory challenges. Some jurisdiction restrict certain arbitrage activity. Arbitrage in the digital age. Technology has revolutionized the arbitrage trading in several ways. Number 1, high frequency trading. About half of all the US trading involve a high-frequency trading strategy, including arbitrage. Number 2 is algorithmic trading. Sophisticated algorithm can identify and execute arbitrage opportunity in milliseconds. And number 3 is retail accessibility. Digital platforms have open arbitrage to individuals and traders, though with limitations. Number 4 is increased competition. Technology has intensified competition, reducing opportunity windows. And number 5 is a new market. Digital asset like cryptocurrency creates an entirely new arbitrage landscape. The cryptocurrency market presents a unique arbitrage opportunity due to their fragmentations and volatility. We have what they call the cross-exchange arbitrage, where they're buying crypto in one exchange and where the price is low and selling in another exchange where the price is high. The inter-exchange arbitrage and exploiting the price differences between spot and the future market in the same in a particular exchange. And crypto arbitrage. What are the characteristics of an arbitrage? A crypto arbitrage. Number 1, speed is critical. The price discrepancies can disappear in seconds. Number 2, automation is essential. Most traders uses bot to monitor price and execute trade. Number 3 is liquidity challenge. Some exchanges may lack sufficient liquidity for large trade. And number 4 is free sensitivity. Transaction costs significantly impact profitability due to small margin. And number 5 is regulatory uncertainty. Legal status varies by jurisdiction. What are the tools that we need to be able to do arbitrage trading? The tools are so many. For example, if you're going to go into arbitrage trading, some of the first tools that you must bring into consideration, you have a knowledge of the workability of CoinMarketCap and CoinGecko. You must have a knowledge of those two, CoinMarketCap, CoinGecko, Arbitrage Scanner, Arbitrage Scanner, Crypto Hopper, Big Gaps, Phonics, and Theory commands, and so many others. We're going to be looking at these tools one by one as we go on in teaching, because I'm going to be releasing more videos on arbitrage opportunities and the tools that we need to be able to become effective as an arbitrage trader. What are the costs and considerations? Transaction fee. Transaction fee is involved in trading arbitrage. You need the brokerage commission, the exchange fee, and other trading costs. Number 2 is slippage. Price changes between order placement and execution. Number 3 is currency conversion. The cost when dealing with international market. And number 4 is technological expenses. High-speed data, feed, algorithms, and infrastructure. And number 5 is regulatory compliance. Regulatory compliance. In this teaching, in the digital age has both increased arbitrage opportunities through new markets like cryptocurrency, while simultaneously making the traditional arbitrage more challenging through increased competition and near instantaneous price correction. Arbitrage remains a vital market mechanism that promotes efficiency while offering a profitable opportunity for those with the right tools, capitals, and speed to capitalize on the floating price discrepancies across the global market. If this teaching has given you value, I will need you to subscribe to my YouTube channel, Web of Fortunes, so that when I release new video, you will always be the one to access it and try and subscribe, like, and share, so that other people can also benefit from this teaching. Thanks.